And that's why I'm telling you, anyone who says they can call the exact top on Bitcoin is a proper donut. End of.
Mate, that's just the crypto game, innit? 90% guesswork,
Yeah.
10% hoping Elon Musk tweets about your coin. At least with Forex, you got central banks messing things up predictably.
Here we go, Mr. All Fundamentals. Listen, today we're getting into the nitty-gritty, proper technicals.
Okay.
CMT level 3 stuff, so put your big boy pants on, yeah? We're talking about combining trend following and mean reversion.
The two houses of trading, the Starks and the Lannisters, they bloody hate each other. You're either a trend is your friend disciple or a buy the dip maniac.
Right.
Who thinks they're smarter than the market.
Exactly. And the traders in each camp think the other lot are complete idiots. Trend followers see mean reversion traders as lunatics trying to catch falling knives.
And the mean reversion lot see trend followers as sheep who only buy the top and sell the bottom. They're not wrong sometimes, to be fair.
True that. But what if you could be both? What if you could be a proper two-footed player? See, you've got your trend following system, right? Let's break it down. You're trying to catch the big, juicy moves.
Right.
Your win rate is garbage, maybe 30-40%. You take a load of small losses.
Proper paper cuts. It's infuriating. You feel like the worst trader on earth.
Yeah.
Your equity curve is all over the shop.
But then, bang, you catch that one monster trade that pays for all the losses and then some. You ride it for weeks, months even. That's your crypto bull run, your Tesla squeeze. You feel like a trading god.
For a week anyway. Then you've got the other team, mean reversion. These are the guys who do the opposite. They wait for the price to get stretched, way overbought or way oversold.
Right.
And they bet on it snapping back to the average.
Their win rate is beautiful, like 80% plus. They're constantly banking small, satisfying wins. It feels amazing. They're buying the dip in an uptrend or shorting the rip in a downtrend.
But the risk they're carrying is monumental. They're the ones who get completely wiped out by one trade. They have no stop loss or a massive one.
Yeah.
Because the whole point is to buy more as it goes against you. They're playing chicken with a freight train.
Interesting. So the actual pro play, the stuff they teach you in the expensive exams, is to combine the two. I was reading this backtest, a proper quant job. They ran a trend-following system on a basket futures and a mean reversion system on the S&P 500. And the magic part, dramatic, the profits and losses from the two systems were almost completely uncorrelated.
And that's the golden ticket right there. Uncorrelated returns. It means when one strategy is having a mare, the other one is probably doing all right. It's like your trend system is getting chopped to bits because the market is dead and ranging.
Which happens like 70% of the time.
Exactly. But your mean reversion system is loving it. It's buying the bottom of the range, selling the top. Cha-ching, cha-ching. It's profiting from the very conditions that are killing your other strategy.
And what that does to your overall account is beautiful, man. The combined performance in that study was way better than either one on its own. The Sharpe ratio, that's your return for the risk you take, it shot up. The max drawdown got smaller. The whole equity curve just smoothed out. It was a much easier ride.
People need to get this in their heads. It's about creating a portfolio of strategies.
Yes.
Not just a portfolio of assets. You see guys on Twitter saying they're diversified because they hold Bitcoin, Ethereum, and Doge. Mate, you're not diversified, you're a muppet. When the tide goes out on crypto, all your boats sink.
Preach. But what if you trade Bitcoin with a trend system and a mean reversion system? Now you're talking. The trend system catches the massive 10x bull run. But what about those savage 50% drops along the way? Your mean reversion brain is firing up, buying that panic, scalping the bounce for a quick 20%.
It's the same in my world. GBP USD might be in a clear, beautiful trend for 6 months. You let your trend model run on that. But then you look at a mad pair like Euro Odd, which just ranges like a drunk spider. A mean reversion strategy would feast on that, fade in every spike up and every dump down.
All right, so let's get practical. How does a regular trader, who's not a coding genius, actually do this? You can't just smash two random strategies from YouTube together and hope for the best.
Step 1 is identifying the market regime. Is the market trending or is it going sideways? You can use an indicator for that. The classic one is ADX. If ADX is high, over 25C, the market has direction. So you enable your trend following rules.
And if ADX is low and flat, under 20, the market is dead, it's ranging. That's when you tell your mean reversion rules to take over. You're basically using a switch.
A more elegant way is to run both systems all the time, but maybe on different assets that suit them. Or, and this is the really clever bit, you build a hybrid model.
Now you're talking. This is the source. A hybrid model is where you're using both ideas in one trade. For example, the main long-term trend is up. You've confirmed that, but you don't just buy any old time. You wait for a pullback. You wait for the price to dip and for an indicator like the RSI to get oversold.
So you're using the trend following idea to pick the direction.
Right.
You're only looking for longs, but you're using the mean reversion idea to time your entry.
Okay.
You're buying the dip, not the breakout. It's the best of both worlds.
It filters out so much noise. You're not buying every single new high.
Right.
And you're not trying to short a monster uptrend. You're just patiently waiting for the high probability entry, a small reversion inside a big trend.
But the hardest part isn't the chart, is it? It's the psychology. The two mindsets are complete opposites. A trend follower has to be comfortable being wrong most of the time, taking loss after loss.
Totally.
You know that one winner will make their year. It takes insane discipline.
Totally. Most people can't do it. They'll follow the system for 9 losing trades, then get scared, miss the 10th trade, and that's the one that flies. They get all the pain and none of the gain.
Then, the mean reversion trader has the opposite problem. They win most of the time. They feel like a genius. But they have to be able to sit through a trade going against them, sometimes massively, and not panic. They have to be willing to take a huge but rare L on the chin. That's a different kind of mental strength.
By running both systems, you're also diversifying your own emotions. On a day when your trend trades are all getting stopped out, you can look at your mean reversion account and see that it's been scalping wins. It stops you from doing something stupid like abandoning your entire plan.
It's the ultimate all-weather approach. You stop trying to guess what the market's going to do next. Is it going to be a trendy year or a choppy year? Who cares? You're set up to make money either way. You're the house now.
That's it. Stop being a purist. Stop getting tribal about one way of trading. It's just leaving money on the table. Be adaptable. Be a chameleon.
Couldn't have said it better myself. That was almost profound for you.
Oh, hey, cheeky. All right, that's enough big brain time for one episode. Before we go, everyone listening, get in the chat group. The link's down below. Hop in and have a laugh with us. It's a good time, I promise.
Yeah, come and tell Chris all his crypto analysis is just astrology with extra steps.
All right. Seriously, though, we've got a question for you lot to chew on. Think about this honestly.
If you had to pick one, what's your natural trading personality? Are you a trend follower at heart? Someone who loves to ride a big winner and doesn't mind a string of losses?
Or are you a mean reversion trader? Someone who loves the thrill of going against the crowd, buying when others are scared, and banking frequent smaller wins? Have a think. Let us know in the group. Catch you on the next one.